Welcome to a short video looking at some of the key economic aspects of commercial banks in the UK as part of your revision for the economics exams in 2020. The commercial banking sector in the UK is undergoing quite a bit of change at the moment. Now you have your established banks like Barclays and HSBC, dominant big players, economies of scale, well-established banks. But of course, as you may know, they're also seeing the emergence of so-called challenger banks such as Metro, Revolu, Monzo, very popular with students, and Starling. It's going to be really interesting to see what happens to these challenger banks in the years to come. Can they establish a foothold in the market for commercial banking? What is a commercial bank? A commercial bank is a licensed deposit taker. Clearly, they have a license to attract our retail deposits, and they provide obviously a range of savings accounts to meet the different needs of households and businesses. Commercial banks are also licensed to lend money, to provide credit, create money if you like, through bank loans, overdrafts and mortgages. Traditionally, the commercial bank's business model was fairly straightforward, fairly simple. It relied on charging a higher rate of interest on a loan, or perhaps another asset, than the rate that you typically pay out on savings deposits. Fairly simple model of banking. You charge a higher rate on the loans than you pay to your savers. And we call this gap between assets and liabilities, between loans and savings, as the spread. So typically, for example, when the rate of interest on loans is interest inelastic, if borrowers are willing to pay a high rate of interest, then typically the spread tends to be higher. You can charge a higher rate to people who need to borrow. Equally, as the market becomes more contestable, then perhaps savings rates will go up as banks are competing for savings, so the interest rate spread may come down. There are three main sources of profits for commercial banks: the interest rate spread, charging a higher rate of interest on loans than the rates paid to us as savers. Banks also charge service fees when arranging a loan, for example. And they also often provide brokerage services. They might provide you with some share dealing services or perhaps some foreign exchange services. And of course, they can make a commission or charge a brokerage fee for providing those kind of banking services. So typically that's the source of profits for banks. I'm not going to spend too much time on banks' balance sheet except to say that assets are owned by a bank on the left-hand side, liabilities are owed by the bank. And of course, assets and liabilities match in a balance sheet, they're equal to each other. So for example, typically, a bank will hold some of its assets in cash in highly liquid format, including the money in cash point machines. Commercial banks are required to hold some balances with the Bank of England. And when they make a loan, then that is also creating a new asset because they're crediting people's accounts, asset or credit creation. And banks also hold slightly less liquid assets. For example, they might own government bonds or invest in property that's slightly less liquid as a financial asset. They also have liabilities, of course, typically the main deposits that you have with a bank, that's your money, it's a liability to the bank. And if a bank creates a loan adding to your account, that is increasing their liabilities on the balance sheet. They may also own money to bondholders, or they might perhaps owe money to other banks. Now, let's look at the bit of detail here, looking in particular at Lloyds Bank. This table is really interesting. This table shows the value of customer deposits of Lloyds Banking Group. In other words, the money deposited in the bank itself. And you can see that whilst there's been ups and downs over the years, basically Lloyds has about £400 million worth of deposits. Now, of course, that money can be lent out many times over. We keep in mind something called fractional reserve banking, that on a given day, let's say a Tuesday, only a small percentage of people with a deposit in Lloyds Bank will go back to the bank and ask for the money back. And even then, only a small percentage perhaps of those savings. So typically the savings that go into a bank, acting as new deposits, they can be lent many times over. Banks only need to keep a small percentage in cash format, in highly liquid forms. They can lend those deposits out many times over to make money. Some of the leading banks in the UK in 2018 are shown in this chart. HSBC is by far the UK's biggest bank in terms of the total value of their assets, over £2 trillion worth of assets. Barclays comes second, then Lloyds. Those are the big players. Royal Bank of Scotland, of course, which was nationalised by the UK government in the financial crisis. Standard Chartered is pretty big. I've put Nationwide in a different colour. It's a building society, so it's not a commercial bank. And building societies typically are owned by their savers rather than by shareholders. Some of the banks, of course, have a significant market share. So this chart shows the gross market share of mortgage lending in the UK in 2018. And you can see that Lloyds Bank was the biggest single mortgage lender in the UK with a nearly 16% market share. Nationwide, Britain's biggest building society, 13%. RBS, Santander, of course, Spanish bank, doing well in the UK on 10%. So you can see this is quite a highly concentrated market. The top 5 firms here, ignoring others, which lumps together lots of smaller banks, the top 5 firms clearly dominating the market with well over 50% of the total market. So commercial banking as a whole is probably best described as an oligopoly. And many banks are highly profitable. So this chart shows the leading European banks in 2019 ranked by pre-tax profits. HSBC making nearly $20 billion. Santander, Spanish bank, doing particularly well. BNP Paribas, so lots of French and Spanish banks in there, and 1 or 2 UK ones as well. Deutsche Bank has struggled recently, so too has Standard Chartered in terms of Europe's most profitable banks, so too is Credit Suisse. And of course, you're not guaranteed to make a profit as a bank. So this is really interesting. Metro Bank has tried to break into the UK market, trying to establish a foothold in the savings and loan sector. But in fact, they made a pre-tax loss in 2019 of over £130 million. Obviously, their operating costs well above the money they're making from lending out. And so the shareholders in Metro Bank will probably need pretty deep pockets before they start making a return on their investment. In other industries, Lloyds, for example, other sectors, Lloyds is highly profitable. But even Lloyds last year, they reported a big fall in profits, down to £4.5 billion. And as a result, their chief executive will have to make do with only £4.7 million as his pay package. How will he cope, we ask ourselves. Lots of students are interested in Monzo. It's a great example of a challenger bank coming into the UK. They now have over 1.5 million customers. I think they picked up about 1 million customers in 2018 alone. They've only got 700 employees. It's pretty capital light business. They've issued more than 2 million cards. You may have one. They've attracted just under £500 million of deposits. So they're making some progress in attracting savings deposits, particularly amongst young people. But thus far, they're not a big lender. So their lending is actually a fraction of their deposits, whereas for most of the big banks, their lending is a multiple of their deposits. So Monzo presumably is trying to make money by investing those deposits elsewhere. It's not yet becoming a significant commercial bank lender to challenge the likes of Barclays and Lloyds. Now, in the old textbook view, there was a simple model that banks, first of all, had to take deposits from savers, and only then could they lend out to businesses. Well, this old-fashioned view is, I could use various words, it's old-fashioned, it's out of date. Banks don't necessarily have to take deposits first of all before they can lend out. How do banks create credit? How do they make loans? Well, banks create credit simply by extending a loan to a business or a household, by granting the loan request. So, for example, when a bank makes a loan, it could be a mortgage to buy a house, or it could be a small business that needs £15,000 to buy some equipment. When a bank agrees to a loan, it credits the bank account of the debtor, the person who's borrowing the money, or the business that's borrowing the money. It credits their account with a bank deposit of the size of the loan or the mortgage. In that respect, banks create money. Most money is not in notes and coins and cash. Most money is in the form of deposits created by the banking sector. And banks can create those deposits. They can give out loans, if you like, because they know that on any given day only a small percentage of their savers will be asking for their money back. So crucially, when a bank gives out a loan, new money is created in the economic system. It appears both on the assets and liabilities side of the balance sheet. But banks don't need to attract deposits from savers in the first instance. They can simply go to the wholesale markets, for example, to raise some money before they lend it out. Well, banks can make money by lending out and by charging a higher rate of interest on a loan than they pay to savers. So what are the limits? What are the constraints on commercial banks if they want to do this process? Pardon me. The first constraint is purely market forces. The scale, the depth, the length of the queue of people and businesses who want to borrow money for business expansion, for a mortgage, what have you. So it depends crucially on the scale of the profitable lending opportunities. Typically in a recession, there are fewer opportunities to lend than there are when the economy is doing pretty well. The second key constraint is the risk of lending. And in particular, we talk about the default risk. The risk that if you lend £50,000 to a business, they end up not being able to pay it back, and that becomes a bad debt. A third constraint on banks are regulatory policies. So the central bank, Bank of England, or another agencies such as the Financial Conduct Authority, they might put in place minimum capital reserve requirements. So banks have to hold back a minimum percentage of their assets, either in cash or other liquid, easily accessible forms, in order to cope with the slings and arrows of outrageous fortune, including economies going into recession or suffering from shocks. So every year the commercial banking sector in the UK is subjected to what's called a stress test. The Bank of England puts forward a doomsday scenario. Unemployment doubles, house prices fall 30%. The economy goes into recession, and they ask the question, do the commercial banks have enough reserves? Do they have enough capital? Do they have enough safety net reserves to be able to cope with that? And that's called the stress test. The fourth factor must be the cost of lending. So the Bank of England essentially sets the base rate of interest, and so the level of policy interest rates must influence the total demand for loans in the market. But most of the loans and savings rates are set by the market, not by the Bank of England. Two key concepts to finish with. One is what's called liquidity risk, and one is called credit risk. And this applies to commercial banks. So first of all, liquidity risk. Liquidity risk is the risk that banks run short of liquid assets which they need to call upon quickly. So banks tend to attract short-term deposits, instant access accounts, for example, but they often lend for longer periods of time, and therefore a bank might not be able to repay all those depositors if savers decide to withdraw their funds. And often occasionally we get a run on a bank where people lose trust in a commercial bank, and there are hundreds of people queuing up outside asking for their money back. So to reduce liquidity risk, commercial banks try to attract longer term savings deposits and pay a better rate of interest, and also hold back some of those assets as capital reserves. Credit risk is the risk that the people you lend to default on their debts. In other words, they say, we can't pay. Won't pay, can't pay. So credit risk is particularly important, and if you've studied the financial crisis, you'll know that the subprime lending boom was a catalyst for the crisis, because banks were lending out to people who were high credit risk, had no income, no jobs, no assets, no verification, and it turns out that was a particularly bad form of lending. Credit risk can be controlled by research into the credit worthiness of the borrower. Can this person pay back their mortgage? Can this business pay back their loan? And also by prudential regulation, so the size of capital reserves that commercial banks must hold back, if you like, as a safety valve in the case of bad debts. Just want to finish off by looking at this chart. There's a lot of debt in the economy. It's sometimes called credit. It's not credit, it's debt. And this is just looking at the amount of unsecured debt for the average person in the UK in 2018. Secured debt will be things like a mortgage, where if you don't keep up with your repayments, you stand to lose your property. Unsecured debt is debt that's not secured on another asset. And in the UK in 2018, so only a year or so ago, the average person owes over £8,500 on personal loans, over £7,500 on credit cards, nearly £2,000 on catalogue debt, just under £2,000 on a bank overdraft, home credit. Millions of people take out payday loans. Lots of people have debt, just over £1,000 on store cards. So what you're seeing here is that the average person in the UK has quite a chunk of unsecured debt, often which pays a very high rate of interest. Household debt as a share of GDP is a major concern in the UK. I'm sure you know this. That makes the banking system perhaps a little bit more fragile, particularly if millions of people in the next recession decide that they can't pay it back. So what we've done here is we've spent 10 to 15 minutes looking at some key aspects of commercial banks, and I hope you found that useful ahead of your exams.